All right, guys, moving on, right? Let's see other areas. Plant is what we discussed previously in the immediately previous segment. So now what we will see is we will see the theater building, hotel building. So generally I'm a movie buff, so I keep going to these movies almost roughly to the theater at least twice a week, to be honest. So there, like if we sit on a recliner chair, etc. Now tell me, is that a machinery or is it a plant? Or is it just a building? So was the question raised. In many cases, it was held that it cannot be treated as plant for the purpose of depreciation. It will still essentially be buildings. It will be buildings. So guys, if you want the material, you can purchase the module 1, which has everything, whatever we are doing. So you can purchase that material. Soft copy cannot be provided, guys. So I hope you understand. Moving on, if the SSC is engaged in more than one business also, you need to understand that the block of asset is SSC wise and it is not business wise. So everything will be taken as an entire whole and you will be charging depreciation on the same thing. So if supported by fundamental income should be computed source wise and not for the business as a whole. So here it is for the entire source, so to speak. And if the unity of control, management, everything is with one person, so you should take the SSE, the entire, that is the source is the SSE. So he has multiple businesses which will be taken from a single SSE point of view. Even if one business gets discontinued, it's okay, other businesses will run, so it will not amount to the discontinuance of the entire business, it's just discontinuance of a one division which can be taken into account. Method of depreciation as discussed for power generation, etc. It is straight line method or WDV, and for others it is written down value method only. So guys, as far as WDV is concerned, so we have seen all the block concept, what are the blocks, etc. that are there, 5%, 10%, 40, 15, 20, 30, 40, 45, and one block of 10% and one block of 25% for intangible and 10% for furniture and fittings. Now, if you have to see the concept of WDV under 43.6, this is how the entire structure would be. So first, WDV of the assets in the immediately preceding previous year, I should take first, less depreciation actually allowed in the immediately preceding previous year, actually allowed. Then you will get the WDV of the block at the beginning of the previous year. Then what will you add? Add actual cost of assets acquired during the previous year. Put to use for 180 days or more, put to use for less than 180 days, and acquired but not put to use. Because the depreciation is on put to use basis and not on ready to use basis. So acquired but not put to use, I should write it separately because for this there is no depreciation. And if it is 180 days or more, it is full depreciation. Less than 180 days, it is 50% depreciation. Less money is payable. Guys, money is payable means money is receivable. In respect of any asset in the block which is sold, discarded, demolished or destroyed together with the scrap value, if any, the deletions during the year. So all deletions during the year I should subtract. And then if at all there is a slum sale in capital gain, you will understand if there is a slum sale, WDV of assets transferred in slum sale will be subtracted. And finally what you will get is WDV for the purpose of depreciation. Less you will now do the depreciation calculation of actually allowed and then you will get the closing value of the block of assets. So guys, as simple, if it's 180 days or more, full rate of depreciation, less than 180 days, half rate of depreciation, assets not put to use, no depreciation. So money is payable, as I told you, will include anything that you receive in respect of that particular asset. So money is payable will include any insurance, salvage, compensation, etc. Where any asset is sold and the price for which it is sold also should be taken into consideration. It is money is payable to the SSE, hence money is receivable. So in case it is completely destroyed and nothing, you get not even 1 rupee for that, you should take it as nil, as simple as that. On the other hand, like for example, if the WDV is, whatever WDV of the amount of the thing before this money is payable is 10 lakh rupees, and some of the assets you sold it for 15 lakh rupees, WDV, final WDV should never be negative. It can never be negative. It should be nil. Always it should be nil. The extra portion can either be short-term capital gain or loss that we'll see later. So technically, if the asset is used for after 4th October of the previous year, then half rate of depreciation. If it is put to use before 4th October, then full rate of depreciation. Because if you compute 180 days, exactly 4th October will come. April, May, June, July, August, September, and October 4th will become my 180 days of use. Now, goodwill. There was an amendment in the assessment year from the financial year 2021 and assessment year 21-22 that goodwill is no longer a part of block of assets. Goodwill portion, whether it is acquired goodwill or whether it is self-generated goodwill, has to be extracted from the intangible block. So from the intangible block, goodwill portion we have to remove. But you would have, what do you say, taken depreciation on goodwill for the past 5 years, assume. So what should I do today? Standing on 1st April 2020, how will I treat goodwill? Let's say goodwill was acquired 5 years ago. I've already given depreciation to, for the goodwill portion 5 years ago only. What will I do? So basically, the lawmaker says you should take goodwill as if it was a separate asset. You should take depreciation as if depreciation on goodwill was already allowed. And then that WDV portion of goodwill has to be removed from the total intangible value. For example, if you see, X purchased intangible asset consisting of goodwill and patents for 20 lakhs. Goodwill was purchased for 10 lakhs. The opening block of WDV was nil. Actual cost of asset acquired during the previous year 20 lakh. Monies payable nil. And less depreciation 18-19. So for closing WDV is 15 lakhs. Then for 19-20, again 15 lakhs I will take. I will subtract the depreciation. This is the closing WDV. Now, as I told you, on 1st April 2020, I should take the goodwill portion out. How will I take it out? WDV of goodwill as if it were the only asset in the block. So if you see, if it was only asset in the block, how will I take? What is the goodwill value? You see 10 lakhs. So 10 lakh minus 25%, minus 25%, 2 years I have to subtract. So guys, what I will get finally was 5,62,000. Mind you, this 11,25,000 has this 5,62,500. That's what it means. So on 1st April 2020, I need to subtract the value of goodwill from that. So from 11,25,000, I need to subtract 5,62,500 from it, and whatever remains, that will be my WDV for depreciation, less depreciation for the previous year, and then whatever I will get, that will be my closing WDV. So goodwill, guys, with effect from 1st April 2020, I should remove from the block and it should be treated separately, is what they say. Now, there could be a scenario where, what do you say? They have used the word actually allowed here. See, check it out. They have used the word here actually allowed. Now, what do you mean by actually allowed? Very simple. Whatever depreciation is allowed as per the act. So here, if you think about it, whatever depreciation is allowed as per the act. So in this example, for instance, what is depreciation actually allowed? 5 lakh. 5 lakh is actually allowed. Can there be a case where depreciation is disallowed also sometimes? Yes, possible. Especially if I am in my, what do you say, manufacturing of tea, coffee, rubber, etc. There are Rule 8 and other rules will apply whereby some part of it is business and some part of it is non-business. Correct? So in tea business, etc., some part of it is business and some part of it is non-business. So just for example, I am telling, if let us say my income is 100 crore, of which let us say 40 crore is considered to be business income and 60 crore is considered to be agricultural income. Fair enough? Similarly, my asset value was 1000 crore, of which now 400 crore is deemed to be, what do you say? Let's say 100 crore. Okay, let me make depreciation here. And 1000 crore is the WDV of the asset, my dear friends. Let me take a depreciation of, let me make it 2000 crore. Let me take depreciation of 200 crore. 200 crore is depreciation, yes, randomly I'm telling. Now the question is, in this 200 crore, correct, 80 crore and 120 crore. 80 crore represents what? Depreciation on business income. 120 crore talks about depreciation on agricultural income. So the question now was, when I am taking the income as only 40 crore, let us say this is income before depreciation. Correct? Income before depreciation. The question is, should I subtract depreciation of 200 crore or should I subtract only 80 crore as depreciation? Should I subtract 80 crore as depreciation and carry forward? Say 40 minus 80 is minus 40. 40 will be unabsorbed depreciation. What is the depreciation I should take? Some of the companies were taking the income portion as 40 crore, but depreciation they were taking full 200 crore. So they were making 40 minus 200, that is 160 crore. 40 minus 200, 160 crore they were carrying forward as what? As, what do you say? Unabsorbed depreciation. Or if this business income happened to be 1000 crore and this is 400 and 600, so 400 minus 200, 200 crore they were offering to tax. So the question was, should I offer 400 minus 200 or should I offer just 400 minus 80? Because 400 represents business income and 80 crore represents that portion. Now this is what is actually allowed, right? So the question here was, what do you mean by actually allowed? Depreciation actually allowed was it the full amount of 200 crore or I should take only 80 crore? Was the question. Many conflicting judgments, etc. happened. That is why this explanation was added here. Check it out. Explanation number 7. When SSC derives income partly from agriculture and partly for business, the total amount of depreciation shall be computed as if the entire income is business income. And the depreciation computed shall be deemed to be the depreciation actually allowed in computing the WDV. So what the what the company is doing was, when I am computing my WDV, I used to take 2000 crore minus just 80 crore. And here I was taking, what do you say, 1920 crore. Ideally, what you should take? 2000 crore minus 200 crore, 1800 crore. So they were okay with this, guys. 400 minus 80, 400 minus 200, all that was immaterial, because here, if I take 1920 crore, I would get a higher depreciation over the years. But if I took 200 crore, I would just get almost, 120 crore less depreciation. WDV would reduce by 120 crore. The question here was, what should I do? Should I take the depreciation full 200 crore or should I take the depreciation 80 crore? Because actually allowed, my dear friends, is just 80 crore. That's what is actually allowed. So basically, my entire business would be what? 400 crore minus 80 crore. For 320 crore, I have to pay tax. That is undoubtedly true. Only 80 crore was actually allowed. So should I take 2000 minus 80 or 2000 minus 200 was the question. If I take 2000 minus 80, which is actually allowed, my WDV will increase by 120 crore. Thereby, over the years, depreciation I can claim. So to ensure that this anomaly does not continue, this particular explanation was added, which you can see in the notes. When the SSC derives income partly from agriculture and partly from business, total amount of depreciation shall be computed as if the entire income is business income. The depreciation computed shall be deemed to be the depreciation actually allowed, which means I should take, what is the depreciation computed? Full depreciation 200 shall be deemed to be the depreciation actually allowed. Why deemed? Because actually allowed is 80 crore, not 200 crore. But I should take full 200 crore and only take reduced WDV. 1800 is what I should take, not 1920 is what this particular section talks about, guys. Hope you understood. So half rate of depreciation, all that that is, fine. So if you see here, for example, let's take one example just to understand. Plant and machinery 15%, depreciation at an opening WDV of 1000. A new plant and machinery of 500 rupees at 15% was purchased on 15 March 22. Part of the plant and machinery was sold for 300 on 20th March. In this case, opening value of the block 1000, add purchases. Assets for more than 180 days nil, less than 180 days. Why? Because it was added, 500 was added on 15 March 22, guys. So add this. Assets not used is nil. Total asset is 1500. But 300 was sold on 20th March 22. That also I should subtract. So value for calculating depreciation 1200. So guys, the sad part of it is, even though if it was used for full year and almost just 10 days before the year ended, you have sold it off. When you subtract it, depreciation you will not get on that 300 crore. 300 crore. So what is depreciation? This 500 is used for less than 180 days, hence half depreciation. Balance. For balance, you will 700, you will get full depreciation 105. So what is the total depreciation? 142.5. Closing WDV of the block will be 1057.5. In the above example, value of the asset sold was 1100 instead of 300. WDV for calculating depreciation will be 400. Depreciation will be calculated at half rate as this balance value remaining in the block from the new acquisition. So in this particular thing, instead of 1100 here, this instead of 300 it was 1100. So what is the balance left? Just 400. This 400 should be assumed that it is part of the new 500 that you have acquired. So you will only get 400 into 7.5 depreciation. If the asset was purchased in July of the relevant previous year but put to use only in December of the relevant previous year, my dear friends. So can I say it is purchased, what do you say, more than 182 days? Yes, but the question here is depreciation must be calculated from the day it was put to use. Even though it was acquired for more than 182 days before, it was put to use for less than 180 days. Hence, half rate of depreciation. Even if you purchase on 1st April, but you put to use only on 1st December, half rate of depreciation, because in Income Tax Act, it is based on put to use. Then example 6 is very interesting. If the asset was purchased in July 21, but put to use only in December 22, depreciation will not be charged for previous year 21-22 as the asset was not at all put to use. And guys, for previous year 22-23, most important thing is depreciation will be charged at the full rate and not half rate, because for half rate of depreciation the wordings are it should have been put to use in that previous year. Which previous year? The same year in which it was acquired. That previous year in which the asset was acquired and put to use for less than 180 days. So guys, if you buy 2 years before but put to use today and that too in December, it is not half rate of depreciation. You will get full rate of depreciation. I hope you understood this. In case of this is just simple quick revision. So you need to make a note of all these things and move on. WDV in case of business restructuring, my dear friends, yes, basically it will be as per the actual cost minus whatever at the time of depreciation you will reduce at the time of reconstruction, amalgamation, demerger, conversion, etc. And then predominantly everything what they'll do is they will split between amalgamating company and the amalgamated company. In all the things it's the same case. Immediately before the transfer, whatever it will be, that only will be recorded. So at the time of transfer, at the time of amalgamation, if the WDV is let's say 10,50,000 rupees, that same thing will be shifted to the amalgamated company is what this particular section tells. Same with conversion, succession and all those things. And of course, proportionate depreciation. In case of succession of business taking place during a previous year, full amount of depreciation is computed and then it is apportioned between the predecessor and the successor in the ratio of number of days of use is what they say. Now let us go into a very, very interesting concept of actual cost. Most important because a lot of explanations are there in this actual cost, which are very much applicable for our examination. Yeah. So the next part of the story is actual cost. So let's go to actual cost and understand what are the various elements here. So actual cost means the cost of the asset to the assessee as reduced by that portion of the cost which has met directly or indirectly by any other person or authority. Met directly or indirectly by any other person or authority. So actual cost will be the actual cost, whatever I bought, minus that portion of the cost is met by some other person. Some other person means it can be government grant, it can be somebody else has bought on my behalf. So whatever the case may be, that portion has to be reduced. For example, if I buy an asset worth 1 crore, of which 20 lakh is donated by somebody else, then that portion has to be reduced from the actual cost. But if it's a gift, we will see how it works later. So that is regarding the actual cost of the asset. So let me check if there are other areas. Along with the actual cost, when we go, there is also additional depreciation, which will come later. So after all these explanations are done, we will go to the additional depreciation concept as well. It will come here, all these other areas. And unabsorbed depreciation and other things, and the SLM basis, which will come. This is how it looks with all the examples here. That will end obviously the depreciation chapter. So first we will do actual cost, then we'll do the other parts of depreciation. We can do either way. We can do depreciation also and then go there. Okay, let's do one thing. Let's finish off types of depreciation and then come to actual cost. So types of depreciation, you have normal depreciation and there is something called additional depreciation. So additional depreciation you will get at 20%, my dear friends. And it is for new plant and machinery. So first of all, it should be new plant and machinery. It should be used for manufacture or production of an article or a thing. And then it should be in the business of generation or transmission of distribution or power. So either power generation or manufacturing of any article or a thing. And it should be for either new business or existing business, doesn't matter, but it should be new plant and machinery, which means old not allowed, second hand not allowed. Even if it is imported into India for the first time, still not allowed. Imported into India also not allowed. Traditional, basically if it's used somewhere else but imported into India and in India it's used for the first time, still not allowed. So you should not get confused. For additional depreciation, new plant and machinery will mean new plant and machinery. But there is something else, specified business, etc. In specified business, even if you import it from outside India, that will be allowed there. So you should not get confused. Here, new plant and machinery means brand new, as simple as that. Additional depreciation is not allowed in relation to building, furniture, intangible asset, plant and machinery installed in office premises, plant and machinery installed in residential premises, office appliances or road transport vehicles, second-hand plant and machinery, whether used in India or outside India, ship and aircraft and all these things. But guys, you would have seen in the factory forklift vehicles. These are also trucks. So if you see, it doesn't apply to road transport vehicles, but it will apply to forklift vehicles used in the factory. So these forklift vehicles you would have seen, large vehicles which are used with a forklift, which is used to, transport goods, etc. from one place to another place in the factory. Those forklift vehicles are very much part of the entire deal. For that, additional depreciation will be allowed, but for these things, additional depreciation will not be allowed. But for newly set up manufacturing units in notified backward areas of Andhra Pradesh, Bihar, Telangana and West Bengal, additional depreciation instead of 20%, the rate will be 35% is what they say. And additional depreciation is allowed in the first year when it is put to use. So if it is put to use for less than 180 days, then you will get instead of 20%, 10%. But the best part is the remaining 10% you can claim it the next year. So there is no bar on it. Definitely you can claim. And additional depreciation is used only and only when WDV method is used. If SLM is used, additional depreciation is not allowed. Then it says for the manufacturing of a thing. So if I am into broadcasting of, I am a TV channel, I'm into broadcasting. I manufacture, I make movies and then I broadcast. I make web series and I broadcast. I'm a FM radio channel. I create content and then I broadcast, telecast, broadcast, whatever. All these things, whether it will involve manufacture or not is the question. So if I buy a brand new camera and I create a new web series and I then broadcast it on television, would that amount to telecasting, broadcasting, would it amount to manufacture? Similarly, I am an FM channel and I will now create something, a new show I will create, a radio show where I will talk about, let's say, mental health, right? And mental health among students, and then the special segment on CA students. Now that part, if I created on my own, and then I'm broadcasting, there are a lot of interviews with various mental health, executives and mental health, what do you say, psychiatrists. Now the question is, would that amount to manufacture? That's the question. So yes, my dear friends, all this will amount to manufacture and shall be eligible for additional depreciation. If you use a depreciation partly for business and partly for personal purposes, definitely proportionate expenses for business personal purposes will not be allowed under 38(2). Then, for example, if my profit before depreciation is 40 crore and my depreciation happens to be 60 crore, 20 crore will be my unabsorbed depreciation. Now that, as per 32(2), interesting use of words, it can be utilized, set off for any number of years. It can be used subsequent years indefinitely is the word. They have not used that it will only be used for 4 years, 5 years, 6 years, indefinitely. So unabsorbed depreciation can be set off against any income except the head salary. So salary income you cannot set off, any other income you can set off. And let's say I have unabsorbed depreciation today of 20 crore and 2 years later I discontinue my business. 5 years later, in a new business, can I claim this unabsorbed depreciation of an old business? Yes, I can. Because in the Bare Act, nowhere it says business should continue. Continuation of a business is not a criteria. Then generally, guys, losses, etc. can be carried forward only if you file the return. But there it says, if you have not, what do you say, filed the return, you cannot carry and set off and carry forward the losses of, section 72, 73, like that they tell. They don't, nowhere they speak about 32(2). So interesting point is the fifth point. Unabsorbed depreciation is allowed to be set off in subsequent year also, even if no return has been filed by the SSE for the relevant assessment year. Then, as far as power sector undertaking is concerned, the concept there is SLM method, and you can use WDV also, but if SLM method is used, very simple. For example, if the asset value is, let us say, the WDV is, let us suppose it is 10 lakh and the sale value happens to be 8 lakh. Basically, we'll sell the asset of the SLM, which was used in SLM basis, it was 8 lakh. 2 lakh rupees is the loss. That 2 lakh rupee loss is termed as terminal depreciation and it is debited to P&L account. On the other hand, let's say the original cost of the asset was 15 lakh. Original cost of the asset was 15 lakh and the WDV is 10 lakh. You sold the asset for 12 lakh. You sold the asset for 12 lakh. Mind you, this extra 2 lakh rupees is an income and it is treated as balancing charge credited to the P&L account. But interesting to know, original cost of the asset was 15 lakh. Your WDV was 10 lakh and you sold it for 16 lakh, more than the original cost. So from 10 lakh to 15 lakh, this will be called as balancing charge, and 15 lakh to 16 lakh, 1 lakh extra will be my capital gain under 50 capital A. It will be capital gain under 50 capital A. That is what it is. And guys, generally in a block of assets, when I sell off the asset in the entire block, if my WDV is, let's say, 5 lakh rupees and I sell either all the assets or one asset in the block for more than the WDV, let's say 6 lakh rupees, that remaining 1 lakh extra will be called as capital gain. So generally, guys, when will the block concept exist? Block concept will exist when there should be at least one asset in the block, plus the block should have some value. Right? There should be at least one asset in the block and the block must have some value. Block must have some value. If the block has no value, then obviously capital gain will arise. And if the block has value but there are no assets only allowed, then of course the block concept will cease to exist. So basically, as I told you, there must be at least one asset in the block and some value for the block on which prescribed percentage can be applied. Even if one of the above conditions are not satisfied on transfer of any asset from the block, provisions of section 32 shall cease to apply and automatically the provisions of section 50 will come into play. So here if you see, for example, there are 8 assets in the existing block which has an opening WDV of 8 lakh. 2 more new assets were acquired during the year which had an actual cost of 3 lakh. So if you see, opening WDV 8 lakh, actual cost of asset acquired 3 lakh, totally it is 11 lakh. And less sale of asset, all 10 assets were sold for 12 lakh rupees. Here asset also is not there and the value also is not there. Hence in this case, block concept will cease to exist. And there is a short term capital gain from, because 12 lakh is the full value of consideration and cost of acquisition is taken to be the WDV 11, so totally it is 1. Mind you, if I sell the assets in the block such that the WDV becomes nil and the WDV, the sale value is more than the WDV, it is always and always and always short term capital gain. Even though if the asset is used for 5 years, 6 years, 7 years, if I sell it, it's still short-term capital gain, because if I make it long-term capital gain, you will get it at a discounted rate of 20% tax rate. But if I make it short-term capital gain, except 111A, in all the areas, it is always normal tax rates. Hence, here since depreciation benefit of 30% has already been taken, it is always deemed to be short-term capital gain. In this particular question, 10 assets were there for 11 lakh, all 10 assets were sold for 10 lakh. There is still 1 lakh remaining, but unfortunately no assets are remaining. In this case, there are no assets left in the block, but there is a WDV for the block. As one of the conditions is not satisfied, provisions of section 50 get attracted and the provisions of 32 will cease to apply. And in this case, there will be a short-term capital loss of 1 lakh. 6 assets are sold at 12,50,000. So there are 10 assets at 11 lakh. 6 assets are sold for 12,50,000. So what is the WDV for depreciation? Only 4 lakh is the WDV for depreciation, the number of assets, but the value will be nil. Here also, my dear friends, you will get what? 1,50,000 rupees worth of short-term capital gain. 6 assets are sold at 8 lakh rupees. 6 assets are sold at 8 lakh rupees. Remaining are 4 lakh assets and here 3 lakh. This is the only scenario where assets are also remaining, amount is also remaining, and hence in this particular case, provisions of 32 are attracted and the block is subject to depreciation. To summarize, if assets are not there, WDV is also not there, depreciation will not come, capital gain will come. If either of the two cases, assets are there, WDV is there, assets not there, WDV is not there, in both cases, capital gain will come, depreciation will not come. The only case where depreciation will come but capital gain will not come will be assets are there, WDV are there. Both the cases, depreciation will come, capital gain will not come, is what they says. It is always short-term capital gain. So this was regarding what? Capital gain. Now let us, this completes depreciation, by the way. This completes depreciation in all aspects. But one additional thing that we have to keep in mind is if at all they ask the stamp duty value also, if they ask the stamp duty value also, then my dear friends, it should always be to the tune of stamp duty value. Because in capital gain, the selling price is 40, stamp duty value is 60 lakhs. And in that case, section 32 will apply. For example, the WDV of the asset was 52 lakh, let's say, WDV of the block was 52 lakh, selling price was 40 lakh, but the stamp duty value was 60 lakh. Then 52 minus 40, so that 12 lakh is still there, no? 12 lakh is still there. So WDV, does it exist? Yes. So since WDV exists, 32 will come, section 50 will not come, and section 50C also will not come. 50C is regarding stamp duty. On the other hand, a WDV is 52 lakh, selling price is 60 lakh, but SDV is 80 lakh, my dear friends. Now you see, 52 minus 60. Obviously, the block will become nil. Now both will come. Section 50 also will come. 50C also will come. 50C will tell that if the stamp duty value is more than the selling price, the stamp duty value is more than the selling price, then you should take the stamp duty value only as the consideration. So for capital gain purposes, I will take the selling price to be the stamp duty value. So I am just connecting capital gain. So my dear friends, let's come to actual cost. In fact, we finished depreciation and now coming to actual cost. Yes. So actual cost means what? Cost of the asset of the to the SSE as reduced by the portion of cost has been already met directly or indirectly. So I told you, if what is met directly or indirectly by any other person, if there's any government grant, etc., then that has to be subtracted. So what is actual cost? Cost of purchase or construction of the asset, that is the purchase price, less amount of GST. So guys, if GST or customs, whatever it is, if I have claimed ITC, since I have already claimed ITC, that will not be forming part of the actual cost. So if the value of the asset is 1 lakh and 18,000 GST separately ITC is claimed, 18,000 will not be taken into account. On the other hand, if ITC is not claimed, then you can definitely add the GST portion also. Especially when there is any block credit. For example, if the company buys a car, obviously there is no ITC on that car, so that portion can be capitalized. Then subsidy or grant, all subsidies and grants should be subtracted. That is what it means here, as reduced by the cost directly or indirectly by any other person. Third one, so guys, if there is anything that is more than 10,000 rupees if you are spending, and that too other than cash, or even by, what do you say, cross check, which means if you are only using ECS, electronic clearing system, or an account payee check. So there's a difference. Since I was a law trainer, I still am a law trainer. What is the difference between account payee check and cross check? Both have the crossing, which means both have to be paid to the accounts only. But an account payee check, on the other hand, it is to be paid to the respective account of the person to whom it has been drawn up to. Whereas normal cross check can be paid into the account, but this can be negotiated further. So if I give it to person A can give it to B, B to C, C to D, D to E, like that negotiation. And finally, the last person can deposit in his bank account, actually withdraw cash and give. So basically, you can do indirect cash dealing. So to curb that from happening, very clearly they have told that it should be an account payee check. Account payee check, account payee bank draft, because if it's a normal cross check, it can be converted to cash eventually. Even though it has come into the books, it can be converted to cash through other means. So that is not covered here. With regard to acquisition of the asset for which payment, so basically if you spend anything more than 10,000 rupees, other than ECS, other than account payee check, other than NEFT, other than IMPS, other than, what do you say, Beam, Paytm, UPI, all that. So your even Paytm, your phone pay, all these will come into picture. Other than that means what? If you use normal cross check, if you use cash, if you pay more than 10,000, if it is a revenue expenditure, my dear friends, it will be disallowed under 40 capital A3. And if it is a capital expenditure, it will be subtracted from actual cost under 43(1). That is the gist of the story. So that's what it says with regard to acquisition of the asset for which payment to a person in a day, a person 1 day, exceeds how much? 10,000. Otherwise than any of these things, then it will come into that picture. So if you see, single payment, aggregate payment to a person in a day, if it goes more than 10,000 rupees. So basically, if the assessee is a buyer and Bakra seller is there, Bakra seller, so 10 lakh rupees asset I bought, in which 7 lakh I paid check. Let's say it is a account pay check. 10,000 rupees I paid for 20 days, 2 lakh, and 1 day only I paid 5,000 rupees into 20 times. So my dear friends, overall, as far as 7 lakh is concerned and 2 lakh is concerned, how much can I capitalize? 10 lakh, 7 lakh, 9 lakh, how much? Buyer can capitalize 9 lakh. Why? 7 lakh is paid by check, 2 lakh is paid by what? It is maximum 10,000 per day. No, I have not exceeded 10,000. So can I take that into account? Yes. So it can be 7 lakh plus 2 lakh, 9 lakh. Remaining 1 lakh. 5,000 into 20 times. Remaining 1 lakh has to be ignored, have to be subtracted from the total cost. If I take 10 lakh, I should subtract 1 lakh, or I can directly take only 9 lakh. Right? So 5,000 into 20 times 1 lakh. 5,000 into 20 times 1 lakh. So basically overall how much, guys? 9 lakh. This is for the buyer you leave. Bakra seller you see, guys. For Bakra seller, this will be coming under a section called 269 ST. You have to think from both the points of view. What will come? 269 ST will come. And under 269 ST it says that in case you have taken cash. Cash means other than ECS, other than NEFT, other than BHIM, other than account pay check. If you have taken more than 2 lakh rupees, either singly like this, more than 2 lakh. You can say, sir, this is less than 2 lakh, so it will not apply. No, it says either 2 lakh at once or as part of a transaction. This entire is a part of transaction. What is the transaction? Selling of a asset. As part of this transaction, if it crosses 2 lakh rupees, in this case, what? 3 lakh rupees. So, under 271 DA, the seller has to pay penalty to the tune of the amount. 3 lakh full amount will go. Deadly. So, you should analyze from buyer point of view, also seller point of view. From buyer point of view, two sections will come. 40A3 and 41, 43.1. That is actual cost. 40 capital A3 if it's an expenditure, revenue expenditure. 43.1 if it's a capex. From the seller point of view, Bakra fellow, 269 ST will come and 271 DA will come. Right? This is what I am trying to tell. Done. Then guys, if I purchase one asset at $80 rupees, by the time of payment of that particular asset, 2-3 months later, I'll have to pay, let's say, I'll pay 50% of that, and unfortunately, it is coming up to that time $1 is 84 rupees. Right? $1 is 84 rupees INR. So that extra 4 rupees, it's not $80, I meant $1 80 rupees. So if it is 4 rupees extra, then what I should do? That extra 4 rupees, I should keep it in mind. Which means I have to add the asset by 4 rupees. Correct? Forex fluctuations, that is decrease in the liability in respect of asset acquired from a country outside India, then you see you add increase in liability. If 80 rupees become 84 rupees, 4 rupees should be added to the cost of asset. If 80 rupees, let's say, become 78 rupees, 2 rupees will be deducted from the cost of asset. That's why this thing remains the same here. Right? Yes. Then expenses incurred towards acquiring the asset, like freight, insurance, unloading, loading, everything to be taken into account. Expenses incurred in connection with installation of the asset, technician fee, erection fee, all that should be taken into account. I have to add it to the capital, add it to the asset. This is very interesting. Interest on borrowed capital. So basically, if I have certificate of incorporation is here, certificate of commencement of business comes here. This is where you have incorporated and this is where you have commenced business. Whenever they say business has been set up, it means it is running. Just by incorporation, you cannot say business has been set up. Set up means what? There are various cases for this also. Set up means what? Actually, the operations are going on. So, until the operations are going on, that is still the here, CCOB. From beginning till the CCOB, what comes? If I have taken some money here, I have borrowed 1 crore. And till here, the interest I have to pay is 1 lakh. And from here to here, interest I have to pay is 50,000 on that asset that I have borrowed. I mean, the money that I have borrowed. Right? Using this money, I will buy the asset here. And I will put to use here. For argument's sake, let me say that put to use will happen, let's say, on the commencement of business itself. For argument's sake, it will be easy to understand also. So on this day only, what I will do? Put to use. After this, during the year, interest is coming up to 2 lakh. So the question is, this 2 lakh, should I capitalize or should it be expensed off? So guys, under 36(1), this has to be taken as an expense. Clearly it is given. Whereas this one, from the day you borrow till the day it is put to use, it has to be capitalized. Has to be capitalized. After this, this cannot be capitalized. It has to be expense. That is what the section says here. Interest on borrowed capital payable up to the date on which asset is first put to use. It should be added to the cost of the asset. So you have your other expenses incurring for acquiring the asset. So until as if I'm manufacturing the asset also, and if I'm acquiring the asset, whatever it is, salary is paid for erection, staff, traveling, vehicle, general expenses, everything should be forming part of an actual cost if I'm setting up a plant, so to speak. Administration and general overhead expenses are specifically attributable to a fixed asset, etc., will be forming part of actual cost. Whereas general administrative expenses of not a factory where I'm setting up the plant, but office expenses of your accounting office, etc., that should not be capitalized. And when I'm doing some test run, let's say I've created a new cola which will now go against Pepsi and Thumbs Up and all those things. For example, Shunya is there. Shunya is zero aerated. It's an aerated drink, but it doesn't have all this high sugar, etc. Zero sugar. Shunya drink. Now, Shunya drink, there will be some test run expenses. Now, test run expenses, in some cases, it will be part of actual cost, and in some cases, it will be not forming part of actual cost, depending on the facts of the case, so to speak. So, in actual cost concept, there are various, explanations that we need to keep in mind, one by one. Explanation 1 to 43(1). Asset is used in the business after it ceases to be used for scientific research. So, if asset is used for scientific research, then very simple, guys. Already I have taken a full deduction in scientific research under section 35. So, even if it's a capital expenditure of 10 lakh rupees, rather than showing it in the asset, I would have taken a full deduction under section 35. Which means I would have debited to my P&L account 10 lakh rupees. But still, after that, can I avail a deduction again, depreciation? Can I add it to actual cost? No. If it is used in scientific research and later it is brought into my normal business, still I have already taken the full benefit of the same. So at what amount should I bring in the asset to the actual cost? It should be nil. It should be nil. That is explanation 1. Explanation 1A, very simple. If I have a stock in trade, I told you the other day already, in the previous part of the video, I've already discussed. If there is a building of which 2 apartments are there, it is converted to capital asset. I'll make it into an office. In that case, on the date of conversion, same FMV of such asset will be taken as the actual cost. Because this, for example, if the building value is 2 crore, FMV is 4 crore. I will have to pay tax on the difference of 4 crore and 2 crore. I have to pay tax on it anyway. So since I've already paid tax on it, this amount can be taken as actual cost and claim depreciation in the near future. If the asset is acquired by way of gift or inheritance, isn't it met by any other person? Yes. So since it is met by any other person, rather than subtracting something, for this explanation clearly says, if the asset belonged to Mr. A, he had purchased it at 1 crore and it came down, and depreciation after 3-4 years, in 2010 he had acquired, in 2020 he is giving it to B, gifting it. At the time of gifting, whatever is allowed to him, if you consider everything, the WDV would be 40 lakhs and is giving it for free to Mr. B. B will record it at what rate? 40 lakhs or 1 crore? Or at random figure he can, take? No. If the previous owner had used the asset for business, if 1 crore was used in business, actual cost is cost to the previous owner minus depreciation actually allowed the previous owner. Let us assume this fellow had used it for personal purpose, but this was used in business. A had used it for personal purpose, but B is using it for business. Then what will happen? Then very simple. If the previous owner had used the asset for personal purpose, actual cost is cost to the previous owner. That's all. What is the cost of the previous owner? 1 crore. So it depends on whether you actually used it or not used it. That is this part of the story. Interest portion we had seen. Explanation 1A we just saw. Actual cost 10 crore assume. But if I bringing it into business, the difference will be taxable and all those things. So guys, if the donor, for him it's a part of the block and the donee it's part of the block, explanation 2 will apply. For the donor it's not part of the block, but for donee it is part of the block, explanation 2 will apply. Because explanation 2 says it will be the actual cost. When will no depreciation effect come? When for the donor it was part of the block, but for the donee it is not at all part of the block, he is using it for personal purposes. Donor had a car which he had used for business. He gave it to me. I am using it for personal purposes. Will the block concept come? No. Will explanation, when block only doesn't come, will this explanation come? No. Very, very simple. One important thing is, when the donor, WDB was 1,96,830 gift. He gifted it to donee at 1,96,830, assume. Right? For the donee, should add 1,96,830 to the actual cost, that we know, that is what explanation 2 says. But for the donor, he has just gifted the asset. What will be the monies payable? Monies payable will be 0. Means has he received any money? No. Legally, no. If you read the Bear Act, there also it says no. But ICAI believes that since he has given the asset worth 1,96,830, that has to be reduced from the block. With whose block? Donor's block. Keep that in mind, my dear friends. So ICAI says, subtract 1,96,830 from the donor and add 1,96,830 to the donee. 1,96,830 to donee should be added in explanation 2, and in explanation, as far as the donor is concerned, 1,96,830 should be subtracted. Hope you got this point, my dear friends.